Hello and welcome to the Providence Investment Update for April 2025. My name is Michael Ogg and I'm joined here today by Marc Wait, Chief Investment Officer of Providence. Welcome, Marc.
Thanks, Mike. Pleasure to be here.
Now, Marc, where do we start? There's so much going on at the moment. Markets are changing every day. Every morning I wake up and the market's done something strange overnight. Look at your title of your GOS, Tectonic Shifts. Can you explain these tectonic shifts?
Absolutely. And I think the start of 2025 that's the best way to describe it. We began the year with a lot of excitement around US exceptionalism, stretch valuations in terms of large cap US stocks, and a very solid belief that the Trump administration was going to be unashamedly pro-business. And then the music really stopped during March, and that came around a feeling by the market that the administration was going to be quite aggressive in terms of their stance on trade. And as we sort of moved into what they called Liberation Day, which was when they announced their tariffs, market expectations was that there'd be an effective tariff rate of around about 10 percentage points. What actually came about was the announcements were far higher. So the effective tariff rate got up as high as around about 23%. And so this had really sort of big implications for people's expectation about the future path of the economy, the future state of the global trading system, how capital flows might change. And broadly, if you sort of look at what's happened, the expectation has been a lower level of economic growth, a higher level of inflation, potentially changes in trade flows, and also just potentially a sort of a fracturing in terms of the global trading system and also the degree of trust in the US administration. So it's been quite a big sort of sea change from an economic perspective.
And Marc, how's that flowing through to the equity market, the bond market, the credit market, etc.?
Yeah, so my sort of previous comment was noting the fact that valuations in the US had become quite stretched. So there was around about 9 percentage points on the difference between the S&P 500 valuation and equities for the rest of the world. And so what you've seen is that the markets really sort of looked through and started to derate US equities from that very high premium. They still traded at a premium, but you saw the S&P 500 come down around about 20 percentage points and then move back up. I think the key point really is that markets don't like uncertainty. And so we saw the VIX, a measure of implied volatility, move from around about 18 up to 50. We saw credit spreads move wider. We saw the US dollar index decline by around about 10 percentage points from where it was in January. And that's a basket of currencies against the US dollar like the yen and the euro and the Swiss franc. The Aussie dollar has been a little bit different. It's kind of been caught in the middle. And that's really because of our trade patterns moving to China and also our degree of dependence on the US. So the volatility in the Aussie dollar has been less. We've seen gold continue to play a really important role as a defensive asset. And we've seen gold prices move quite high. This morning they printed above $3,300 an ounce. And then we've also seen government bonds move around as there's been sort of conjecture around how constrained central banks might be in their ability to ease policy in that environment of sort of light stagflation.
And Marc, look, just focusing on bonds in particular for a second, because they're the cornerstone of investment markets. They seem to have changed Trump's mind with the movement in the bond price, the last week or so. Can you just talk through that?
Sure, and that's absolutely right, Mark. Your point around bond rates being the discount rate for a lot of different assets around is really important. And so with that move for expectations that economic growth was going to be slower, so not 2%, probably below 1% for the US, you saw bond markets rally quite strongly. And they sort of moved from 4.5% in the US for 10 years down to around about 3.9%. And then we saw a very sharp reversal. And I think really that was what worried the Trump administration. We got back to that sort of 4.5% level in a very swift manner. Markets were quite unstable. There was discussion around quite a lot of hedge funds unwinding their over-leveraged position in US Treasuries at that point in time. And I think it was the combination of the sharp volatility in equity markets, credit markets, and bond markets to some extent that started to worry the administration that they might lose control. And I think that was a little bit of a trigger for that pause in tariffs that occurred, and also some very sort of soothing words from Scott Bessent, who is a former hedge fund manager, has a fair amount of knowledge of market dynamics, And the point they've been making is they've really sort of fed out the tariff narrative to be very focused on the great power struggle between the US and China and the ability to be transactional and do deals with the rest of the world. So markets got a little bit of comfort, not a huge amount, around perhaps we know what the ceiling is for countries around the rest of the world.
And Marc, given all the volatility and given all the noise, how have the portfolios actually performed over this period?
So, I mean, in this environment, we've been very pleased with how resilient Providence's portfolios have been. So I think if you sort of look at the structure of our portfolios, we've been very focused on diversification. And those of you that have listened to this call before, we've really emphasised how important that is. So we've diversified our equity exposures. We've had meaningful sort of allocation to cash within portfolios. And then an asset that I wrote about back in August, gold, has played a really important role in terms of cushioning the portfolios through that period. Gold back in September was around about $2,500 an ounce. It's currently 3,300. And combined with a slightly weaker Australian dollar, that's really provided some good cushion within portfolios. There's also been things within our portfolios like infrastructure. That asset's done well. So if you think about an environment where people are looking at a slightly higher resting rate for inflation, that asset class has actually done really well in this environment.
Yeah, that's good to hear. And Marc, just think about the risks going forward. I mean, obviously there's a lot of risk already being priced in, but I'm sure there's more risks to think about and maybe more to come. Can you just talk about the risks you're currently seeing?
Absolutely. And at Providence, we're always very aware of where the risks might be in markets. We're very sort of passionate about the protection and preservation of capital within portfolios. And so we're acutely sort of focused on the dynamics as we move forward in this fast-changing environment. So we're looking at things like economic growth. We think it's kind of a line ball decision that you might get a slight recession in the US, not a particularly deep one. But if that was to move to a deeper recession, that would be something that we'd be very focused on. I think the other risk is that potentially there's a little bit of broken trust in terms of US assets. So you may see a continued de-rating of US equity markets relative to the rest of the world. And then we also want to sort of have a look at capital flows. So we do have quite a strong view that we think currencies to some extent will be the escape valve for this. So perhaps those trends that we've seen around the US dollar continuing to depreciate might stand there. And then the fourth thing that I talk about, lots of risks out there at the moment, would be because of elevated inflation, how much room does the central bank have to ease policy? So in major financial market events historically, you've seen central banks ease sort of 300, 400 basis points. We'd think in this environment, and indeed Jerome Powell in his speech overnight confirmed that, there's probably not as much room for them to ease as what there might have been historically because of that higher level of inflation. Okay.
And Marc, there must be some opportunities as well. Volatility provides opportunities. So where are you seeing the opportunities?
Absolutely. And that was a title that we wrote for a GOS back in 2023 when we had the enormous volatility around the US banking crisis. And so we're always looking for where the opportunities are. So where we think about it, we think that sort of valuations in equities in other parts of the world are reasonable. So when we look at European equities, they're trading on around about a 13 times forward PE at the moment. And we think with some of the fiscal stimulus that's going on there, that's an environment that will be interesting. We think gold is an opportunity in terms of diversifying risk within portfolios, and we think that the demand for gold will continue to be strong, particularly as you see reserve managers diversify away from the US dollar into gold as a currency. We also think that infrastructure is going to be a really interesting asset at this point in time. Governments with constrained balance sheets and assets that have a degree of inflation protection priced into them should be attractive in that environment. So we're quite excited about this change, and we're quite excited about the structure of the portfolios and the opportunity to sort of buy assets at reasonable prices. And if we get a meaningful sort of downdraft in the equity markets, we'd see an opportunity there as well.
Marc, thank you very much. Thank you for your time.
Thanks, Mike. Pleasure.
And thank you for watching. I hope you enjoyed the discussion. If you have any questions, please do reach out and give us a call. Until next time.